Hello everyone, I am Pankaj Bhatia. I am your mentor for the day. Today we'll be discussing a very important topic as this will give you an insight about the financial industry and help you choose the right career path for yourself. So in this session, we'll understand what is the overall industry trend and outlook, risk management and compliances which are to be followed, financial instruments available, digital transformation and innovation the industry is going through, financial analysis and modeling, and role of a fintech in the financial industry. So let's understand the industry trends and outlook at a macro level. So currently there are a couple of events which are happening globally, which includes war between Russia and Ukraine, Israel and Hamas, and the new government which has been formed in the United States of America. So as per the industry experts, banks are struggling with the core income, which is the interest income for the bank, and the situation there is a bit tightened. Apart from that, banks are spending higher on the manpower expenses, the technology investment they have been doing to be future ready, and currently the credit quality is slightly stressed, which experts believe that the situation will get better in 2025. Then apart from this, as per the Basel norms 3, banks are required to maintain higher capital, which is affecting their liquidity. Apart from this, systematically important financial institutions, example HDFC Bank, ICICI Bank and State Bank of India, they are expected to maintain higher margin. A report on this was released by RBI last week only. So as per experts, there are a couple of things which are actually putting banks in a tight spot, which is one, the stress on the interest income. Second, the expenses which banks have been doing on the manpower, then the technology. So experts believe that banks needs to focus on the non-interest income, which is not the core income, but definitely that will ensure that the top line growth is intact. So now let's understand the risk management and regulations in banking. There are a couple of risks once the large institutions like a bank runs, there are a couple of risks involved. So the first risk is the credit risk. So credit risk happens when there is a insolvency or maybe there are issues with the credit worthiness of the borrower. There are some issues in the overall industry and the banking as an institution doesn't want to lend, or maybe they are facing issues while recovering the money which they have already lent. Next is the market risk. Market risks happen in a couple of scenarios, which can be a interest rate risk or a equity risk, wherein the stock prices of a particular institution where either they have lent or their own stock prices go down. Then there are reasons related to currency. When there is a higher fluctuation in the currency, then also there is a risk which is involved to the bank, just because as a bank the exposure is large, which runs into billions of dollars. Then there are commodity risks also which are involved, and last but not the least, there are regulatory risks also, which either RBI comes up with, government of India, or maybe it can be at a macro level also. Now comes the operational risk. Operational risk can happen due to a couple of reasons, which can be due to a human error, a system failure, or maybe there is a disruption in the entire supply chain or the bank system, or maybe RBI comes up with something new which can possibly halt the entire banking system, which has not happened in the past, but there are risks involved. Then comes the liquidity risk. Liquidity risk is when a company is not able to meet the financial obligations, which can be due to a couple of reasons. They don't have liquidity at that particular point in time. The market is behaving such that the overall liquidity is in a tight spot, or maybe there are tightened cash flows through which industry is facing, and then it ultimately impacts a financial institution also. Then comes the reputational risk. Reputational risk is possibly there are a couple of complaints from customers. It can be for the industry, it can be for a financial institution. But here we are talking about financial institutions, so there are customer complaints which are impacting the overall image of the bank or a financial institution. Quality is not there in terms of servicing or in terms of product. Customers are not feeling secure as a financial institution, or there is a negative media coverage due to which possibly there can be a couple of negative rumors in the industry. Last but not the least, there is a compliance risk also. Compliance risk happens when there is a legal action against the institution, or maybe there is a new player which has come in the market and it is disrupting the entire industry with some or the new innovation. It can be due to some regulatory restrictions which RBI has put into a particular financial institution. I'll not name the institutions, but again, the news are there in public domain. So, a couple of banks have been penalized in last 1 year due to some or the other reasons. Now we'll understand the financial market and various instruments which are available for individuals or government of India or corporates to trade in those and park their money or borrow whenever there is a surplus or there is a liquidity crunch. So first is the money market. This is a market wherein debt securities are being traded from overnight, which is 1 day to a year. It enables government and companies to meet their short-term funding requirements or provide liquidity to the financial system. So this includes commercial papers which are being issued by the corporates or state governments or government of India, and then comes the corporate debt, corporate debentures which are being issued by the same, which is either institutions or companies or government. Then comes the capital market. It is a market wherein there are a couple of instruments which are being traded, which include stocks, bonds, and other financial instruments. When it comes to stocks or equity, there are two markets which operate in India. One is a primary market, rather it doesn't operate in India. This is a global scenario, so every market or every economy operates like this only. So one is a primary security which are being issued by the companies which are not listed, and they get listed with prior SEBI approval. So one can invest as an individual or as a financial or as an institution, not financial. The other institutions can also invest money there. So you can invest money and be a part of their growth story. The secondary market is a market wherein normally the equities are being traded, like a couple of companies, including Reliance Industry, all the banks which are there in India. They are being traded, and multiple other companies are being traded in the stock market. Then comes the bond market. It is a market wherein the securities are available with a fixed maturity. So example is, if you invest a lakh of rupees, the security comes with the 7.5% fixed rate of interest, which is being paid annually, and it comes with a fixed maturity. So it can be either 1 year, 2 year, 3 years, or even beyond that. These securities are being issued by again the corporates or the government or government of India or even the state governments. Then comes the forex market. It is a very wide topic. It needs couple of hours to explain, but I'll give you a broad sense. So the forex market is where all the currencies are being traded. There are a couple of strings attached to it when it says when I said that the currencies are being traded. So couple of rates and couple of other things are involved, but broadly the currencies are being traded which are high in circulation. Example, dollar, US dollars, or Australian dollar, or Canadian dollar, euro, pound, then couple of other currencies, and their forwards and option rates are also available in the forex market. This is possibly one of the biggest markets which operates in India, which operates globally. So my bad, which operates globally, and the overall turnover per day exceeds $6 trillion. This is as per a published media report. Then comes the commodity market. It is a platform wherein raw materials or natural resources or metals are being traded. So gold, silver, platinum, and then in energy, natural energy, and in metals there are a couple of metals which are being traded. Agri also, there are a couple of agri related things which are being traded in this particular market. So at a broad level, financial instruments are typically assets which includes retail and corporate loans, plus the real estate which financial institutions and banks are holding. Liabilities includes cash which is lying there in the bank accounts, TD which is term deposit or a fixed deposit, debt instruments which banks invest whenever there is a liquidity. Uh, so capital requirement is also one thing which is considered as a liability for a financial institution. Capital requirement is when the banks and financial institutions, as per RBI norms or as per Basel III norms, the banks are required to maintain some amount of ratios or capital with the Reserve Bank of India. Then comes the equity, which includes stocks, shares, equity mutual funds. Derivatives includes forwards, options, swaps, debt, debenture investments also. Then comes the commodity, which includes precious metal, agri-related, energy-related, crude oil is also one of the financial instruments. So now we'll understand the digital transformation and innovation which banks and financial companies are doing to be one future ready, and secondly to automate the processes to ensure that manual intervention is not required or maybe it is least required. So one, banks have moved to digitalization of channels and services. This includes making payments online. So long back, we used to go to a particular branch, fill in a physical form, and then give a check. Transaction used to get processed within half an hour, 45 minutes, and then the ultimate time to reach the destination was 24 to 48 hours, which was defined by RBI. IMPS and UPI were not there, which now banks have introduced, or rather RBI has introduced along with NPCI. Then all loans and investments, which were earlier, every process was supposed to be manual, and then every time a physical form was required. But now that everything has moved to the digital mode. Then comes the automation of process and operations. So calculation of a interest on a particular fixed deposit, or maybe the interest outflow on a particular loan, and couple of these things. Now everything has been automated. Once a FD is getting matured, it automatically comes to the account. Then comes the data driven decision making. So with AI coming into play, every best possible suggestion to a customer is being automated, and AI suggests what is the next best possible thing which a customer needs, or maybe if customer has taken a particular service or a particular step, then it automatically suggests what is the next thing which is supposed to be done. Now we'll understand what is the innovation which is happening in the banking or financial industry, where all the institutions are putting in tons of money to be future ready. So in last couple of years, some banks have tested, and they have done a couple of transactions on the blockchain technology. So when it comes to blockchain technology, first let me clarify, this has nothing to do with cryptocurrency. Cryptocurrency is a currency and blockchain is a technology. So there is a difference between both the things. So we will definitely do a session on the blockchain technology. My background is not technical, but I still understand what is blockchain chain technology at a very, very minute level. And then we'll discuss a couple of cases, use cases on the blockchain technology, which can be helpful for banks. Banks are definitely doing that, but for your understanding, I can take one or maybe two use cases and then explain what is the blockchain technology. So in last 2 3 years, a couple of banks like Kotak, I can quote those names just because this is again public domain. So Kotak did a couple of transactions and sent a LC via blockchain technology. So this is a very cost effective mechanism, so that is why banks are testing, and this has a background which will remain in the systems for possibly 100, 200 or 300 years, or maybe beyond that. So that is why the banks are testing, and it is a very cost effective mechanism. Then comes the artificial intelligence and machine learning, wherein all the companies again are investing heavily. So with AI coming into picture, the systems are automatically suggesting what is the next best possible product which a customer will require. So just quoting the example, today if you book a fixed deposit with a bank, so then it will automatically suggest you that you can take a overdraft against that fixed deposit in case you need it in future, possibly 2 months, 3 months, or maybe 6 months later. So the system automatically suggests you that okay, this is the best possible thing. Or once you do a large transaction on a credit card or a debit card, it automatically advises that you can split this amount into a 6 months or a 3 months or a 9 month EMI. Then comes the machine learning, which is replacing all the manual work. So machines are doing anything and everything, whatever is required on the operational front. Then comes the Internet of Things. Again, this is a very interesting thing, and it is also a very wide topic. So money like digital currency, which includes the digital rupee also, which RBI has recently launched. This can be stored in digital wallets or maybe a wearable technology like a watch. So that particular watch will have a wallet, and then you can store it, and all you have to remember is a key, which definitely will have a backup. So this is what Internet of Things is all about. So now we'll move on to a very important activity which a bank is supposed to do, or a financial institution, is financial analysis and modeling. So when it comes to financial analysis, the financial institution is supposed to analyze the entire financial health of a company, which includes their balance sheet, profit and loss statement, and to understand what is the health of that particular company and how they have been performing, and what is the projection, or maybe what is the future likely to be for that particular company. This is required either when an institution is extending working capital, or maybe extending a loan to a particular company, or they are promoting or distributing their instruments, as in either the commercial papers or corporate debentures. In financial analysis, there are a couple of things which are required. One is couple of ratios which needs to be analyzed, starting from a basic ratio like a current ratio or a quick ratio, and it goes as high as uh, uh, covering the overall financial strength of the company, to understand how the company has been performing in past, and what is the future going to be. So with this financial analysis and modeling, the financial institutions comes up with what are the areas for improvement, what is the risk they are seeing, what is the opportunity either for a merger or a acquisition, or maybe if at all they expand within themselves, not merger and acquisition, but if they expand within themselves, then what is the opportunity for the future. So financial modeling includes income statement model, balance sheet model. All these models are basically to analyze what is the strength of a particular company, how they have been doing. Are we seeing any risk? Are we seeing any opportunity? Is there any particular thing which they foresee can be a challenge or can be an opportunity also? What are the couple of scenarios? If those scenarios are being followed, then what can happen? What can be a, problem statement or a problematic situation for a particular company? So this financial modeling helps these companies to understand if they are performing well, and as per the industry standards. Now comes a very interesting topic, which is role of a fintech in a banking or a financial industry. So fintech is nothing but financial technology companies. These companies in last 1 decade has been helping the financial institutions to smoothen their processes. They have come up with a couple of innovative products, and they are helping the banks to ensure that everything happens seamlessly. So they have been helping the banks in digitalization. So recently there was an article in a newspaper, and RBI suggested that they are thinking of moving couple of transactions like RTGS, NEFT, IMPS, and other digital modes of payment to fintechs. So fintechs will take all the load from banks, and then banks will be focusing on the other core activities. Undoubtedly, this is also a core activity, but this requires bandwidth, systems, and couple of resources which are to be deployed to ensure that everything happens seamlessly and there are no issues in the system. So we have covered payment system, then lending and credit. So if at all you have heard of a concept called FLDG. So FLDG is a concept which has been existent in the industry from last possibly 5-7 years or maybe more. So FLDG is one concept which fintechs have come up with, and they are co-lending with banks. So the concept says that if at all something goes wrong, so then fintech will take the first hit, and then possibly the bank will take the other hit. But the core underwriting, which is job of a bank, which is role of a bank, and the banks have been expert in doing that. So the entire credit underwriting will be done by the banks, and then the risk will be spread in a particular ratio with a fintech. So FLDG stands for First Loan Default Guarantee. Yeah. So then comes the innovation which these fintechs have come up with in last possibly 5, 7, 10 years, like processing of blockchain technologies, then new business models. Then UPI was also designed with in consultation with a couple of fintechs which are large names like Bharat Pay or maybe Paytm or likes of these. Then financial inclusions is providing access to financial services which are not there for possibly tier 3, tier 4, tier 5 cities where the banks are not available. So these fintechs have been lending to them with the help of the banks, or even without their help. But these fintechs have been ensuring that the financial system is so strong that every customer or every territory which is not served is being served by them. If you have any questions pertaining to this particular video, please feel free to write on the email ID which is there on the screen. Very soon we'll be coming up with couple of interesting sessions like blockchain technology, wherein we'll discuss use cases pertaining to banking industry. Then we'll discuss another topic which is forex, wherein we will cover cash, term, and spot terminologies which are frequently used in this particular market. Another session wherein we'll discuss difference between mutual funds, portfolio management services, and alternate investment funds. For more interesting sessions, please follow us on YouTube. Thank you.